There's a specific dollar amount in federal law that forces your bank to file a report directly with the federal government, and most retirees over 65 have never been told this number exists or how an innocent transaction can accidentally put their account under IRS scrutiny. The number is $10,000, and the law behind it has been in effect since 1970. Under the Bank Secrecy Act, every bank and credit union in the United States is legally required to file what is called a currency transaction report whenever a cash transaction crosses that $10,000 mark in a single business day. The report goes to the Financial Crimes Enforcement Network, which is a division of the Treasury Department, and the IRS has full access to that database. It does not matter whether the money is completely legitimate. It does not matter that you have banked at the same place for 30 years. The moment a cash transaction hits that threshold, the report is filed automatically, and your account information, your social security number, and the transaction details are part of a permanent federal record. But here is what most people do not realize, and this is the part the bank teller will not explain to you. The $10,000 threshold is not the only tripwire. Under federal law, banks are also required to file what is called a suspicious activity report when a transaction of $5,000 or more raises concern, even if it is well below $10,000. The threshold for a suspicious activity report is not a fixed dollar amount, it is a pattern. Frequent deposits of amounts just below $10,000, repeated withdrawals in similar amounts, or any pattern a bank computer flags as potentially designed to avoid. The $10,000 reporting line can all trigger a separate report that carries more serious weight than the standard currency transaction report. And unlike the currency transaction report, which fires automatically at a fixed number, the suspicious activity report is filed at the bank's discretion, which means there is no reliable way to know when one has been filed on your account because the bank is legally prohibited from telling you. Before we go further, if you are finding this useful, go ahead and subscribe now, because in a minute we are going to walk through the 4 specific account behaviors that most retirees never think twice about, but that put them directly inside the pattern the federal government was designed to flag. The first behavior is something called structuring, and it is a federal crime under Title 31 United States Code Section 5324. Structuring means intentionally breaking up cash transactions to stay under the $10,000 reporting threshold. The law does not require that your money comes from anywhere illegal. It does not require that you have done anything wrong with your taxes. Simply depositing cash in smaller amounts because you want to avoid the reporting, or because someone told you that keeping deposits under $10,000 would keep you off the government's radar, is itself a felony, punishable by up to 10 years in federal prison and fines up to $250,000, with the added possibility of civil asset forfeiture before any conviction has even occurred. This is not a technicality used only against drug dealers. It has been applied to small business owners, farmers, and retirees who deposited legitimate cash in amounts they believed were private. A private landlord collecting monthly rent in cash, a retiree selling personal items at an estate sale over several weeks, or someone who simply prefers not to have large sums sitting in one transaction can all find themselves inside the pattern the law was designed to flag, even when every dollar is accounted for and every tax obligation has been met. The second behavior that draws scrutiny is an unexplained gap between your total bank deposits and your reported income. This is a technique the IRS uses in audits called the Bank Deposit Analysis Method, and it works exactly the way it sounds. The IRS adds up every deposit that went into your accounts over the course of a year. Then it compares that number to the income you reported on your tax return. If those two numbers do not match up, the difference becomes a question the IRS wants answered. For retirees, this can happen innocently when you transfer money between accounts, deposit proceeds from selling a car or a piece of furniture, or move savings from one place to another. If those deposits are not clearly documented and the total is higher than what appears on your return, the IRS treats the unexplained amount as a potential source of unreported income. The burden is then on you to show where the money came from, not on the IRS to prove you did anything wrong, which is why keeping even informal records of large transfers, sale proceeds, or account movements is worth doing before you ever face a question about it. The third behavior involves interest income reporting, and this one operates automatically without any action on your part. If your checking or savings account earns $10 or more in interest during the year, your bank is required to file IRS, Form 1099-INT, reporting that amount directly to the IRS every year, without exception. The IRS then matches that figure against your return, and if you did not report the interest, you will hear about it. For retirees who have significant savings in interest-bearing accounts and who have been filing returns the same way for years, a bank that quietly adjusts the interest rate upward or sweeps savings into a higher yield product can create a mismatch on the return, without the account holder ever noticing until a notice arrives in the mail. The fourth behavior that most retirees do not think about is holding cash above the FDIC insurance limit. The Federal Deposit Insurance Corporation insures deposits up to $250,000 per depositor per institution. If your combined checking, savings, and certificate of deposit balances at a single bank exceed that amount, the portion above the limit is not protected in the event the institution fails. Most retirees who have been with the same bank for decades and who have moved Social Security income, pension payments, and IRA distributions into the same account over time have never recalculated whether their combined balance now sits above the threshold. The accounts look the same on the surface, but the protection level is not the same as it was when the account was first opened. It is the kind of thing your bank has no obligation to point out, and they generally will not. The FDIC limit has not changed since 2008, but a lot of retiree account balances have, particularly for anyone who has been consistently depositing Social Security, pension income, and required minimum distributions into the same institution for 15 or 20 years without reviewing whether the combined total has crossed the line. So to bring this together, the federal government has multiple overlapping systems for monitoring bank account activity, and most of them operate automatically without requiring anyone to make a judgment call about you specifically. The $10,000 currency transaction report fires the moment a cash transaction hits the line. The $5,000 suspicious activity report fires when a pattern draws attention. The structuring law under federal code creates criminal exposure even when every dollar is completely legitimate, as long as the intent was to stay under the reporting threshold. The bank deposit analysis compares your total deposits to your reported income every time you are audited, and your bank files an interest income report on your account every year, whether you check it or not. None of these systems were designed to target retirees specifically, but they apply to every account in the country regardless of age, and most people over 65 have never been given a clear explanation of how any of them work. If you have ever moved cash through your checking account and wondered whether it could raise a flag, drop a comment with your age, and what prompted the question. And if this helped you understand something your bank was never going to explain, subscribe so you do not miss the next one, because these rules exist whether you know about them or not.